So we'll just start, and you guys will see the screen again at the end. So Ali and Anna are the right folks from the Kinect side if you're interested in this particular project or the real estate specifics. And then we'll be talking about PCM Encore, the family office, some of the investment strategies that pair well with opportunity zone real estate. You can reach out to Caleb if you'd like to learn more, and he can put you in touch with the right member of our team. Or, as always, you can head over to our website and don't have to write this down. We'll send out lots of information afterwards. So with that, let's dive into Opportunity Zones 2.0. So let's start with opportunity zones in general. And I think it's kind of a fun story. It's only a decade ago or a little more that opportunity zones started. And I think we sort of forget the origin story. So, I think opportunity zones now are associated with, cranes and real estate. And I don't want to say boring, but, far away from the AI world. But it really originated in Silicon Valley and in the technology world. And I'd still say a lot of the best application and the success of it has really been linked to technology. So it's actually Sean Parker, Napster, co-founder, founding president of Facebook, famous in the social network for saying, $1 million isn't cool. What's cool is $1 billion, played by Justin Timberlake, who had the idea behind this. And really the core idea was you had these trillions of dollars of unrealized gains sitting in Silicon Valley, and they were kind of stuck. And he said, man, could we create a incentive for folks to take these funds and invest them in areas where they're most needed? And that's exactly what happened. Real estate became the dominant use case. We'll talk later about why that was the case. I think it's been broadly seen as a highly successful program, which led in 2026 to the expansion, I'd say, improvement and the permanence of the program. So I think you have to start with that first insight that came from Parker and from Silicon Valley, which is, you've got these assets, you're stuck in unrealized gain, and it's a major tax drag. And a lot of that is because you have to earn a lot more to recover from taxes than you're actually paying the tax. So for someone with a short-term New York, tax at a 52% rate, you've got to more than double your money to make up for that. And even someone, somewhere in like Florida, facing a federal minimum cap gains rate, you're still looking at a 32% gain. That could be a decade of stock market gain. And I think as a result, you have a lot of people whose portfolios are not ideal. So as I look at kind of OZs and the problem we're solving, it's really two. One is I have an upcoming capital gains, or I've just had a capital gains. What do I do with it? How do I defer and minimize it? And two is I've got this asset, I'd like to diversify, but capital gains is really standing in my way. So how can I facilitate that? And that's exactly what this program was designed to do. Now the question is, it didn't have to just be real estate, right? You could have, there are a few things you can't do in opportunity zones, but there's a wide swath of businesses you can do. Why was it that real estate became the dominant use case for opportunity zones? And I think for that, we have to really understand what is the tax treatment of an opportunity zone. So the first thing it lets you do is defer. So if you have a capital gain that you made today, rather than that tax being due either this quarter or certainly within this tax year, we can defer that tax for 5 years. The next piece is there's a step up, which means in 5 years, $1 million tax could be reduced to 900,000. There's some things around rural zones where that step up can be up to 30%. And then you have a tax-free exit. So once we've invested that capital gains in an opportunity zone, if we hold that then for 10 years, the appreciation on that asset is tax-free. The bonus depreciation to me is really the area where the real estate becomes really interesting. So in the same tax bill in 2020 or 24, the big beautiful bill, we had bonus depreciation. And what that means is in real estate, we build a big building, and you're able to write that off from a tax perspective. And in residential real estate, we're often writing off more than our equity investment because we're also able to depreciate the debt portion. So for a $100 investment in a real estate project, we're often looking at $120 in depreciation. And that depreciation can shield your income. If you're an active real estate investor, you can use it against all parts of your portfolio as a professional. If you're not, you can either count that against this or other passive investments. But typically in real estate, that bonus depreciation came due when we sold, right? That was then recaptured as capital gains. However, what we have on the OZ is this tax-free exit. So what it means is if, we invest $1 million, that $1 million becomes $2 million. Not only are we getting that $1 million of appreciation tax-free, but the depreciation we're taking on our investment is also not recaptured. So this is really why something where you can take depreciation like real estate is a particularly interesting use case on OZs. And this is just an example of what that stacking means in action. So, this is, the same asset, we put it in a 5% bond, and you put it in a real estate asset at a 5% tax rate, and you end up after 10 years with like 3 times the return from the real estate asset than from the taxable bond, again with the same nominal component. And what we get on real estate is we get that depreciation tax shield, we get some appreciation, and then we have the shield on the actual exit and the depreciation not being recaptured. And this is why it takes a strong real estate investment and on an after-tax basis makes it looks highly interesting. And this is a little bit where Encore comes in, and how do you pair this across your whole portfolio beyond the real estate? So, it's nice to not have to pay our capital gains for 5 years. That's valuable to us and have the step up. But a lot of people say, man, is there a way that I can not pay that tax altogether, or I can at least defer it for a longer period? And that's where you can pair opportunity zones with things like direct index stock. So this is what I did when I sold. I invested about 100 million in opportunity zones. I invested about 400 million in the stock market. And with the direct index, you can match the S&P 500, the NASDAQ, pick your index, but you're directly holding the stocks. And what you do is you match the return of the index, but you sell stocks that go down. So every day, every year, some stocks go up, some go down. By harvesting those losses, you're able to create capital losses. And what that means is, we take that $1 million, we invest it in an opportunity zone, we have that deferral and step up. So now that $1 million has gone to, $900,000 in taxes. But that 4 million, meanwhile, directly indexed, is tracking the stock market, but we're harvesting capital losses every year. And oftentimes, depending on what the market did, by year 5, we're able to offset some or potentially all of the deferred gains. So we're able to grab enough losses from the direct index stock to actually take out that gain in the opportunity zone. So we've taken that deferral, and now we have it either further deferred in our direct index, or if we don't sell those stocks, we've made that deferral permanent. I will note this is not for everyone, but if you are a real estate professional, the opportunity zone itself will take care of this. We typically in opportunity zones between year 2 and 3, you'll get your certificate of occupancy. You'll be able to take depreciation on your investment, and that depreciation itself could be used against that capital gains tax that you've deferred. So a little nuance for real estate professionals there. But long story short, this really works within a portfolio, and there's other strategies to kind of further enhance the tax benefits. So what changed under Opportunity Zone 2.0? So obviously we had the first iteration of the program, and then Congress made some significant updates. So the first one was they made the program permanent. This was initially kind of a one-time program. It was intended after the financial crisis to really kind of reinvigorate investment. And I think on the success, they've created it as a repeatable long-term tool. As part of that, there's now a rolling 5-year deferral. So if you remember in the first opportunity zone, you had these particular specific dates that were unchanging around step up and deferral and things. Now you have a deferral clock that starts on your investment date, no matter which year it's in. You have new zones from 2027, and that's something we'll talk about in this particular investment. So one thing that was identified is much of the opportunity zone investment went into the highest income zones, and there was a feeling that a lot of the investments were made in places that you wouldn't actually need the tax incentive. Um, that's certainly the case in Portland and the tract that we'll show you. It's a relatively high income area, and we would do this deal with or without opportunity zones. So they're tightening up those zones. We still think there's going to be great opportunities, and we're watching that. But in this particular case, we have a grandfathered track with significantly higher income than what we expect from the new zones. And then we have the 100% bonus depreciation restored in the same bill, which really strengthens the tax component. And the way to think about the bonus depreciation is that will not be recaptured if you hold it for 10 years. For the average investor, what's that going to do? It's going to mean that this particular investment, you will likely not pay any tax on the distributions that we have come out every year. 6 to 8 to 10% distributions, those should be well sheltered by the bonus depreciation. And then for those of you that have other components of the portfolio, other things like passive income from other sources, or if you're a real estate professional, you may be able to use that depreciation earlier on to cover other income from the portfolio. But I think that the simplest way to look at it for the average individual is that depreciation really shelters the income and cash flow that you'll be receiving from an opportunity zone investment. And I think we've been over this. I think that the biggest change for those of us in the industry is it's now permanent. We have a rolling 5 years. OZ 1.0 was really deadline based. Where now I think we can now view this as at least for now a permanent function of the real estate and investment ecosystem. Now, I think the core piece is a couple of things. Let's talk about timing, and let's talk about how we think about it. So, for timing, really, it's the start of next year when the new OZ kind of 2.0 kicks in. If you think about the rules for the gains that can come in, probably any gain that comes in through a K1 structure this year will be eligible. And then if you sold an individual stock as of a couple of weeks ago in mid-July, we're now in that 6-month period where you'll be able to roll it in at the end of the year. So really think of, from an investment standpoint, really from a couple of weeks ago forward, and likely anything through a partnership structure, you will be under those more beneficial 1.0 or 2.0 rules. If you have something from earlier this year, but within the last 6 months, you could likely invest, for example, in the project that we'll talk about under the 1.0 rules. I have a significant investment in this project under the original opportunity zone rules. There's still a lot of benefits, not quite as beneficial as 2.0, but just a couple of nuances. And now I think as we kind of transition from OZ to what we're doing, the biggest thing we have to worry about and think about is do we have a great investment? And I think if you look at where really any tax shelter, but where the OZ has gone wrong, it's where people do unnatural things to try to save on tax. So really, how we look at it at Encore and Kinect is, do we have a great investment that would stand alone? And then we have all these tax benefits that maybe take a good investment and make it a great investment or further de-risk it. So now let's talk about real estate. OZ has become synonymous with real estate and multifamily real estate. Again, I think the reason for that is the opportunity zones have been great places. It's where we want to build, affordable multifamily housing. The depreciation treatment makes it particularly attractive. 10-year holds make a lot of sense. It's, we like these as long-term assets. Why do we like multifamily? Strong growing income. You're starting with yields that are, similar to the bond market. But we have very consistent rent appreciations from there. We have significant tax advantaged investments. We talked about depreciation, 1031, as we talked about opportunities, there's a lot of ways to shield income from real estate, to transition in and out of real estate investments in a more tax efficient way. Our president is a real estate developer, and it's maybe reflected in the tax code. We'll go through some charts. You just get really consistent, resilient growth out of multifamily real estate, which makes it a really nice defensive, resilient part of the portfolio and a nice complement towards more cyclical, high growth equities and other parts of the portfolio. And you get real diversification. This is an asset class that has historically not tracked with equities. It zigs when others zags. And as we're putting together a portfolio, that's really a lot of what we're looking to achieve. So this is just some charts that really show what we talked about. So if you go all the way back to 1972 and you look at overall real estate returns and market returns, they're incredibly similar. And if you chose a different index in a different year, you might see the stock market doing a little bit better or real estate doing a little bit better. But over the long term, you have really gotten equity-like returns. But you've done that with true diversification. And as we're building a portfolio, that's what we're looking for. And you can see public REITs, have had some correlation to the markets. As you look at private real estate, it's had very little correlation to public equity markets. And it gives you that diversifying part of the portfolio that you otherwise might be thinking of a bond for example. How do you actually make money on it? If you look at the core return engine, it really comes down to income over time and then growth over time. So real estate is a third of the inflation bucket that we have. So when you think about inflation over time, that really is real estate. This is a chart from 1960 of the median gross rent, and you can see, virtually every year it's continued to trend upward. There's been, relatively little volatility to it, and that's really what you get in real estate. As those rents increase, your income increases. That income increases the appreciation. And then critically, right, in real estate, we're using leverage. And what that means is a 3% growth in rents can often translate to a 6 or 7% growth in the income that you're getting, and then ultimately the value of the equity. So we like it because it's a different return engine than company earnings, right? And what drives the stock market. And it's interesting if you look on the gold chart, that's that cost to rent over time, and the second chart is pricing. So there is a lot of volatility in the price of real estate, but if we actually own apartments and we rent them out, it's a lot less volatile than the kind of the headline numbers around the real estate market, which is why we think about really long-term holds, and why this is the difference between owning apartments versus owning condos, right? And in one, you're taking a lot of cost risk, and others, we're really focused on that core rent driver. And as we think about endowment style portfolios, what sophisticated family offices are doing, we really look at what are these asset classes that give us equity-like returns, but have less risk and less correlation to equity. So we look at private real estate in the same way as triple net leases, private infrastructure, and private equity. This is where sophisticated family offices go, because you're getting that diversification, but you're not giving up returns. And that's the problem with the traditional 60/40 stock and bond portfolio. The bonds, are giving up, significant returns relative to the equity market. So we're looking for things where we get that diversification, but we're not necessarily needing to give up those expected returns. And I think, like equities, there's a lot of different types of real estate with different risk and return profiles. So as we think about the least risky, the equivalent of owning kind of the stock market, think of this as your public REITs, your B REITs. You can expect a 6 to 11% return. You're buying, stabilized assets, and you're really just expecting every year to see some rental appreciation as the driver. You've got value add in the middle. That's where you're buying something that's already operating. You are trying to do some renovations, some repositioning. And then we've got development. And to be clear, OZ is development, right? In order to meet the rules around investment in the zone, you are typically doing ground up development. It is the highest return profile in the real estate risk spectrum, but it's certainly the riskiest. And that's why I think the partnership and thinking through who you're doing this business with is so important. You are taking dirt, you are entitling it, you're architecting it, you're building it. It's a massive project. So the execution risk is the highest. But as is the return that you can expect. All right. And with that, I'll turn it over to BJ to talk a little bit about Kinect, and then the particular opportunities on 2.0 that we have currently available.
Great. Thanks, Mike. So, Connect Real Estate Partners was born out of a strategic partnership that started between ACG and the Paulus family office over 7 years ago. After many successful partnerships and another recent successful fundraise, Mike and I decided to open an investment management firm that could provide private wealth investors access to institutional investment opportunities. And then you have the partnership with American Capital Group. ACG was founded over 40 years ago and is a vertically integrated real estate company that designs, develops, builds, and manages multifamily communities throughout the Western US. We have developed over 16,000 units and acquired and executed on a value add strategy of another 7,500 units. Today, we own and manage over 6,000 units with a property AUM of around $2 billion. Our current development pipeline totals 3,300 units across 10 different developments, representing 1.8 billion in development costs. It's also worth noting that ACG has never had a loan default or foreclosure over our 39-year history. A little bit about ACG's vertically integrated platform. What sets Connect apart from other managers is our strategic partnership with American Capital Group. ACG's vertical integration provides cost efficiency, an enhanced layer of quality control, and operational alpha. From conception through design and development to start of construction to lease up and stabilization, ACG controls the outcome. This provides projects that are high quality at competitive costs and efficient operations that can be modified at a moment's notice if necessary. Our institutional partners. I've partnered with many household names over the years, having raised $1.3 billion in equity from institutional LPs such as Blackstone, Prudential, New York Life Insurance, Canyon Partners, Clarion Partners, to name a few. On the debt side, we work with many of the national, super regional, and local banks, in addition to life cos, such as Pac Life. Our takeout or permanent financing historically goes to the government-sponsored entities, Fannie Mae and Freddie Mac. One thing I'd like to highlight is that we are a conservative sponsor, and if you reviewed our loan portfolio, you would find that we are 95% fixed rate. We did not follow the majority of our peers in the floating debt strategy, which may have been cheaper at the time, but now has become very expensive. These are some of our photos our team took at our groundbreaking in Gresham just a few weeks ago. The key message here is simple. Gresham is not a concept on paper. Construction is already underway. That is important because investors are not stepping into a project that still needs to solve for land control, entitlements, permits, or a theoretical start date. A lot of the early stage development risk has already been addressed. There is still construction and lease-up risk, of course, but we are much further along than a typical ground-up investment at the time investors first see it. In the middle of the picture, you have Mayor Stovall. It was a great opportunity for us to hear from him his priorities, which are a business-friendly climate, public safety, and investment in local schools. This is a quick overview of the live opportunity. Connect to Gresham is a 305-unit ground-up multifamily in Gresham, Oregon. The fund is targeting a $27.8 million fundraise, a 10-year target investment term, a 6% preferred return, and a $250,000 minimum investment. The sponsor is expected to co-invest approximately $14 million, or about 35% of the total equity, which is a very meaningful alignment point. We are investing alongside LPs and taking the same real estate risk. Completion is expected in Q3 2028 with cash flow targeted within roughly 36 months. So investors should think of this as a development that becomes a cash flowing asset rather than an income investment on day one. The investment case comes down to several factors working together. We have a fully entitled site, construction is underway, we have favorable land basis, construction costs that are more attractive than they were at the 2021 peak, and a sponsor with deep experience executing this exact type of multifamily development. The OZ structure is powerful, but we do not want investors to lead with the tax benefit alone. The real estate has to work first. In our view, Gresham is compelling because the fundamentals, basis, timing, location, execution, and supply and demand dynamics all support the investment thesis before we even layer in the opportunity zone investments. From a resident perspective, this is a very livable and convenient location. The property is near light rail, walkable to Gresham Station, retail and dining, close to historic downtown Gresham, and adjacent to Columbia Trails, which ACG has operated for more than 2 decades. That matters because we understand how residents use this location in real life. The amenity package is also designed for today's renter. State-of-the-art boutique fitness, over 3,000 square feet, co-working lounge, a resident lounge and game zone, a great room where that can be rented out for a Friendsgiving or other types of group events, outdoor courtyards, a pet spa, package lockers, and bicycle storage. Those details are not just cosmetic, they help drive lease up, they support resident retention, and position the property competitively over a long-term hold. I would also like to point out on that it is also the only project that will have air conditioning in the market for all of its units. We have a strong history in Oregon, developing over 1,500 units over ACG's 40-year history. ACG first bought the broader site in 2000, completed Columbia Trails in 2003, and has been operating next door ever since. That gives us a level of local knowledge that an outside sponsor simply cannot replicate with a market study. We know the renter profile, rent growth, renewal behavior, occupancy trends, operating expenses, and the day-to-day demand drivers because we have lived with them for more than 2 decades. Our underwriting is informed by real operating history and not just the third-party reports that our peers would order. Gresham benefits from 3 forces coming together at the same time: constrained supply, suburban migration, and income and employment growth. Construction starts are down significantly, and the broader Portland market has seen a real slowdown in new development. At the same time, households continue to look more affordable, family-friendly suburban locations with access to jobs, transit, and amenities. Gresham sits in that lane. It is still connected to Portland, but it offers a more affordable cost of living and a strong renter base. The combination of what gives us conviction in the market over a 10-year hold period. The site location reinforces the demand story. Residents have access to light rail, Gresham Station shopping, historic downtown Gresham, and major employers within a short drive. Portland is accessible by light rail, and employers like onsemi, Microchip, Legacy Health, and Boeing are nearby. For renters, that means the property offers both daily convenience and regional connectivity. For investors, it means demand is not dependent on one single employer or one narrow renter profile. The location has multiple demand drivers that support durability over time. The supply chart is one of the clearest parts of the thesis. Portland MSA deliveries fall from roughly 8,000 units in 2024 to about 1,260 units in 2027. That's an 85% drop. In Multnomah County, where Gresham sits, 2027 deliveries are expected to be 0. Then in 2028, the county shows 305 deliveries. And guess what? That's our project. That is an unusually clean supply setup. Multifamily development has a long lead time, so even if capital markets improve tomorrow, new competing supply would not arrive immediately. We are aiming to deliver into a window where the competitive set is extremely thin and where demand should have time to absorb the prior supply waves. What sets this investment apart is that it is not just an OZ tax story. The best opportunity zone investment is the one you would invest in without the tax benefit. Here, the ground is already broken. The site sits in a grandfathered opportunity zone tract. The land basis is attractive, and ACG has a long operating history next door. On top of that, the sponsor co-investment is expected to be about 35% of total equity versus the typical 2 to 3% you often see in the market. That is real alignment. The tax treatment should make a good investment better. It should not be used to justify a weak real estate thesis. And then finally, this is not our first opportunity zone. We have completed 3 opportunity zone investments. Kinect at Lynnwood. We started construction, completed construction, stabilized leasing, refinanced all in 28 months. We were able to thread the needle on financing timing and came away with a low rate and returned 60% of our investor equity through a cash out refinance. Kinect at Burien. We completed well ahead of schedule and under budget by $2 million. Capital markets conditions were not good when we went to refinance this project, but because we manage operations so tightly, we were able to go from what could have been a cash in or cash neutral refinance to pulling out 18% of our investors' capital out. Enzo at Lynnwood. We set out to raise our debt and equity capital stack in 2024, which was not a good time to be out in the capital markets. However, since our design, development, construction teams are so close to our capital markets team, we knew what it would take to get a project financed. And that is what we did. We did our first Lifeco deal with Pacific Life for our construction loan and our first equity deal with Clarion Partners. This project finished at least 6 months ahead of schedule and was also under budget. We just opened the doors in April and we are already 35% occupied. For those running mental math, that is around 23 units a month. I should also note that the rents are at or above the original pro forma rents, proving out our assumptions from years earlier, despite the current softness in market conditions.
Excellent. Thank you so much, BJ, for that. And now we'll let Allie go ahead and lead the audience Q&A. We're really excited to hear your questions.
Yeah, thanks, Mike and BJ, for that intro. And BJ, great overview of Gresham. So lots of questions coming in, and Mike touched on this in the beginning, but if you have any questions, feel free to enter them into the chat and we'll make sure that we either address them here or afterwards. But the first one here, it looks like it's related to development risk. So BJ, we'll pass this to you. So I know Mike touched on it in the beginning, but as we know, right, development carries more risk than some stabilized real estate. Can you talk us through some of the specific risks associated with development, and then maybe also touch on how ACG mitigates those? And have you had a development fail? This question is asking.
Yeah, so development does carry real risk, and I think it's important to be direct about that. The main risks are entitlement risk, construction cost risk, schedule risk, financing risk, and lease-up risk. The way we try to manage those risks is by controlling as much of the process as possible. We are vertically integrated, so we have in-house design, development, construction, and property management, which gives us better visibility into pricing, timing, execution, and day-to-day operating assumptions. On Gresham specifically, several of the highest risk steps are already behind us. The land is controlled, the project is fully entitled, permits are in place, and construction is already underway. That does not eliminate the risk, but it means investors are not stepping into a speculative pre-development concept. They are investing in a project that has already cleared most of the major milestones. As far as failures, we have never had a project fail in the sense of losing control of a development, abandoning a project, or being unable to complete it. That does not mean every project is easy or that everything goes exactly according to plan. Development always involves challenges. Costs move, schedules move, capital markets move. But across our OZ track record, our 3 OZ projects have been on or ahead of schedule and under budget. That execution is one of the reasons we are comfortable putting significant sponsor capital alongside our investors in the Gresham OZ.
Thanks, BJ. Super helpful. This one, maybe we'll pass to Mike. This is more on OZs 2.0 more broadly. So Mike, can you talk to us about the liquidity options for OZ 2.0? So specifically, can an investor move from one OZ fund to another OZ fund without losing those tax benefits that you talked us through?
That's one that I'm not a tax lawyer. I think in terms of you cannot go from OZ1 to OZ2, but this project can actually take both. So, if you had money in an OZ1 fund, that's something that we should look at. In terms of, liquidity, let's talk through the option set there, because a 10-year hold does sound kind of scary. So the first option from a liquidity standpoint is what's designed within the asset itself. So, we build this in 2-3 years, we're stabilized, and the idea is you're starting to get income, right? You're starting to get, 6-8% a year and largely tax sheltered. So, that right there over 10 years to return, 50 to 60% of your cash flow through that's, one great way to get income. The second piece of the liquidity, BJ talked about, when we go and stabilize, you have the chance to refinance the project. And just depending on where capital markets are, at times you can get either a portion, there's been projects where you take out, all of your equity. There's times that you don't have anything, but there's opportunities to put debt on this. That's not considered selling it. And that's something that you can look at for liquidity. Really depends on where capital markets are at, but that's another option that you have. You can sell before 10 years. You just don't get the deferral, or excuse me, you do still get the deferral. You don't get the elimination of the capital gains. We will keep our eye on that, and if there was some extraordinary reason to do that, it's something that we would take a look at. But I think the project really works best as a 10-year hold where you don't have the depreciation recapture or the capital gains. I will be out over my skis a little bit here, and we do have in-house tax counsel here at PCM Encore. I'd be happy to talk to you more about this. There are some opportunities if you exit an OZ early to roll it into another opportunity zone. So that is something to look at if you have that specific circumstance. In general, this is a very illiquid investment. So I think if you looked at the pros and cons of it, there's a lot of pros that we've talked about. I think if you looked at the risk side, it's really the development risk. I think ACG is an exceptional developer, but that there's an area of risk there. The cash flows are delayed a couple of years as you have to actually build and stabilize the asset. I think that is different from a REIT. And then certainly the 10-year hold. I think the key is you want, I believe private real estate is an excellent part of a long-term portfolio, but you have to want to believe that and hold it to make this worthwhile. You shouldn't do it just for the tax component. I think it's, it really all comes together, in my opinion, when you're diversifying. You like the idea to put part of that in private real estate anyway. You could use a strategy like the direct indexing that we talked about to potentially offset some of those taxes as well.
Thanks, Mike. Sticking with you for a second. So this question is in regards to the types of gains that can be invested in an opportunity zone project. So the question says, can you convert stock market gains and invest those into an OZ fund, or does the gain have to come from real estate?
It can be any capital gain, and it can be short or long term. And again, talk to our tax folks before you finalize this. But I would say the most common use case for OZ is stock. So for me, I had a private tech company. We sold it. That's what I used. I also had some appreciated shares of our acquirer. So the prototypical OZ, individual might have, a bunch of SpaceX, Anthropic, or just, we've all had a lot of stock market growth. You sell that stock within 6 months, we put it into an opportunity zone, and we get all these benefits. If you are thinking about appreciated real estate, you have some other options. So, I think if you have real estate and let's just say your cost basis is near zero, so it's all gain, I would look at opportunity zones, but I would also look at a 1031 exchange. And we also have opportunities for that. And at Encore, we could show you a variety of options. If you have real estate and you have a $4 million cost basis and you're selling it for $5 million, I think the OZ works really well because in the 1031, you have to tie up that whole $5 million. Where in the OZ, you could go do whatever you wanted with the $4 million cost basis. You could take that $1 million gain and roll it over. So I think that's on real estate, you've got some options. And if you own stock, I think real estate's a great example. There are other things, direct indexing, exchange funds, or something that we look at. So we're also happy to have a broader conversation. And a lot of times the right answer is to use a few different methodologies to, diversify your portfolio as tax efficiently as possible. But the short answer is absolutely private and public stock is probably the most significant use case for opportunity zones.
Thanks, Mike. BJ, I think this one's for you. So if we talk about the Gresham project specifically, can you talk to us about the businesses or the surrounding area in Gresham, specifically I know we touched on it in the presentation, but why we're so bullish on Gresham?
Yeah, sure. So, why multifamily or why Gresham now? I mean, multifamily is simple to underwrite at the highest level. People need housing. And they need it in every economic environment. That's the floor. The interesting question is, where you own it. The Pacific Northwest is distinctive because supply is constrained by design, not by accident. Oregon's urban growth boundaries put a hard limit on outward development around Portland. You can't solve a housing shortage here by building another ring of suburbs the way you can in Phoenix or, say, Dallas. That's a permanent structural feature of this market, and it's why we're comfortable with a 10-year horizon. The constraint isn't going away. Then there's the near-term picture, which is unusually stark. The Portland MSA delivered roughly, like I said earlier, 8,000 units in 24. In 27, that's about 1,200. In Multnomah County, where Gresham sits, 2027 deliveries are 0. And as I said earlier, in 28, only 305 units are getting delivered as of today, and that's our project. What makes that more than a 1-year story is the lead time. Multifamily takes 3 to 4 years from decision to delivery. So even if capital came back tomorrow and starts resumed immediately, nothing new arrives until the end of the decade. The scarcity we're delivering into is already locked in, and it has a long runway. Meanwhile, demand doesn't pause.
Yeah, and I think just a couple of things on that. So Gresham is a very affluent area, and Oregon overall had some of the most affluent opportunity zones in the country. This tract will not be part of the new opportunity zones. It's considered one of those tracts that is a little too affluent, and that's why we love it, right? Because it's an affluent area. So, we like it because it makes a lot of sense on its own. Having owned the adjacent land and operated it for 20 years, we've seen the rental increases, we've seen our occupancy, so we really like the area. Another defense mechanism is because it won't be part of the OZ 2.0 tract, you're not going to see more opportunity zone money coming into the area. And a lot of our general thesis, right, is we want to be places where it's hard to build. And it sounds kind of counterintuitive, right? It's like, hey, don't you want to be places where it's really easy and you've got friendly government? So we want the exact opposite. That's what creates supply constraints, right? That's why you get, great rental increases over time. Austin has had a lot of population growth. It's also had 14 quarters of declining, rents. And that's because you basically have unlimited supply. So when we think about places like Bellevue, Washington, places like Silicon Valley, San Diego, and Portland specifically, we have geographic constraints. We've got oceans, we've got mountains, we have governmental constraints, real restrictions on how to build. And within that, we have a lot of friction that makes it actually hard to get things designed and built. And we love that because ultimately, when we can successfully navigate that, it leads to less competition, it leads to pricing power and better investment. So we're much more supply driven in our thesis because even the market with the best demand tailwinds, if there's just nothing stopping supply, then you're never going to have really enduring pricing power.
So a couple of questions here on the difference between 1031 exchanges and OZ investments. So I'm going to try and summarize a couple that have come in. So can you maybe talk through the difference in the type of investment in each of those? So specifically, it looks like they're asking the capital gain obviously goes into the OZ investment. How does that compare and contrast to a 1031 exchange program, and what does it look like for an investor?
Yeah, it's a great question. So I think the first question is, what do you have to invest? In a 1031, you have to invest the entirety of your investment, right? So if I sell a building for 5 million and I have $1 million in gain, in 1031, I need to roll over that entire 5 million, where in an opportunity zone, I need to just roll over the gain. So depending on the investment, that could be, a significant difference. The next piece is the deferral mechanism. So in 1031, I've rolled it over. I haven't gotten rid of it, right? So, if I keep 1031ing my whole life, eventually I could die and have that be stepped up. Where in the opportunity zone, because when you eventually sell it at 10 years, you don't have any depreciation recapture. You have, genuinely permanently eliminated what you've depreciated. And then there's some structural differences, right? In 1031, you really have to trace the money. So prior to closing, you need to identify a trust account within 30 days. You've got to identify your investment. So it's very structured, and both at Kinect and Encore, we do a lot of 1031, and it's a great program. You have a little bit more flexibility in opportunity zones, right? You have really 6 months to go into an opportunity zone if you've made an individual sale. If it comes to your K1, you might even have a little bit more time. So you don't have to do things at the time of the sale. You just have to make that eligible investment a little bit later. And then critically, 1031, it has to be real estate. There's some nuances around it. It has to be investment real estate in particular, where there's really no limit on opportunity zones. As long as you have a qualifying capital gain, you can use it. Now, the flip side is to get all the benefits, or a good chunk of the benefits in OZ, you obviously have that long holding period. 1031, you could, routinely make tweaks and exchange out. Now, I will say, if you were to hold something fewer than 10 years, I don't think there's anything that prevents a 1031 on the backside of an OZ. Like, we're getting really nuanced there, but that's the highest level difference that to think about. And then the key with 1031 is you have some more options, right? It doesn't have to be in an opportunity zone. You can 1031 into an existing building. You don't have the same development requirements. So it's a much broader program, but more real estate specific.
Helpful. Thanks, Mike. BJ, this next one will come to you. So the potential investor is asking, so talk to us about, what does a dollar look like? So from the day you commit capital, day one, into an OZ, what does it look like? What's the distribution profile, or what's the timeline to the first distribution?
Right. Sure. So the first thing to say is that the timeline actually starts before the deal. Starts with your gain. Sorry, it starts with your gain, and when you realize, it changes what we do. So if your gain comes after roughly July 8th of this year, your 180-day window runs into 2027. In that case, we won't call your capital until January 1st, 2027. So the investment lands under OZ 2.0, and you pick up the rolling 5-year deferral, the step up in basis, and the current benefit structure. There's no reason to close early and give that up. If your gain was earlier, and your 180-day expires before year end, we close before that clock runs out. You're working with the prior OZ 1.0 rules, but the deadline is real, and we're not going to let it lapse. So the first conversation we have within the investor is about their gain date, not our closing date. That drives everything. From there, the project timeline. Construction is underway with completion expected Q3 of 2028, followed by lease up. Underwriting anticipates cash flow beginning after stabilization, call it less than 36 months from investment. The funds also contemplate potential tax-free refinance proceeds during the hold, though the timing and amount depend on execution, interest rates, and lender terms. So this isn't an income investment day one. It's a development that becomes a cash flowing asset when stabilized.
Thanks, BJ. Very helpful. Mike, let's send this one over to you. So we talked a lot about the benefits, right, for an OZ investment, the deferral, tax shielded income, tax-free appreciation at the exit. Is there one of those, few benefits that we talked about that, weighs more heavily than the other? And then this, we're also getting a question here. For each one of those benefits, is it possible to just walk through a simple example of what that looks like?
Yeah, it's a great question. I'm going to say take a cop out and say the most important thing is that the project, I think, is really good, and it stands on its own as a free market. And I think where people have gone wrong in opportunity zones is that they've really focused on the tax side of things. Let's talk through each of those benefits, and let's just do a $100 investment. So you take $100 and of gain, and let's just say you're in New York, so you may owe $35 to $40 today. So if we can defer that 5 years and we step it up 10%, all of a sudden you don't owe that tax for 5 years and you owe 10% less. we would then advocate for you to potentially look at things like direct indexing or other things. So in 5 years' time, we've actually minimized or potentially reduced that tax. So that's very significant, right? Like the goal is to either defer that capital gains or potentially eliminate it. So let's take that same $100. We will depreciate. So we will, you will see a passive depreciation loss of perhaps $120. And you might say, Mike, how can you depreciate more than you invest? That's because we have debt on this as well. And when you build a building, we get the full depreciation, including the part of that building that was built on the debt. So if you think about that loss, that is very significant, and that may actually be, depending on the capital gains that we end up with, the most important, because that $120, we're shielding ordinary income, right? So if you think about that, 6 growing to 8, 9% distribution every year, if you were to get that off a bond, for example, and you're in New York, your tax rate might be 50%, where because of that depreciation, you're entirely shielding it, right? So depending on your tax rate and state, your distributions after tax might be almost double what they would be, right? So you're taking home that entire 6.5% distribution rather than 3.5 or whatever it might be. And then the fact that when you sell, you don't recapture that depreciation is very unique. So typically, when you sell real estate, unless you 1031 or something like that, you owe that back. You owe it back at a preferred capital gains tax rate, so it's still better. But I think the depreciation without recapture is missed, and that's why even if you invest in this with OZ 1.0 money, like myself, right, the 5 year is less relevant. To me, the depreciation without recapture is very significant. And then at the end, if you're at 2.5, 3 times the ability to exit and have no capital gains, could be very significant. It's obviously the one that's most dependent on the actual performance in capital markets and things like that. But if I think about exchange funds, if I think about direct indexing, all the other things that we do to try to be tax efficient and diversification, they're all essentially deferral mechanisms, right? And unless you plan to hold something until you die, if you sell, you still have, a tax due. This is one of, the really few things where at the end you've actually extinguished and permanently eliminated a capital gain. So I think the underwriting, which is more important, will really depend upon the actual performance. I think the deferral, if you can plan it alongside, some tax loss harvesting to eliminate that gain, that's something where just the math is really clear no matter how the project does. I think the depreciation, the ability to really have the income from the project be tax free, is significant, and then you have the exit. So they all play a role. And by the way, we haven't talked about it, but there's 3 or 4 other local tax breaks that we've gotten because of affordable housing, because of other negotiations, that they keep stacking. So it's one of those pieces that when you try to actually add up all the different tax advantages, it's a bit remarkable.
It really is. BJ, let's send this one over to you. So there are questions about construction risk. So we know material costs, labor costs, they've swung quite widely in the more recent past. How do you underwrite that risk? What does it do to returns? Can you talk us through how you think about that?
So we underwrite construction risk very carefully because it's one of the biggest risk factors in any ground up development. The advantage for us is that ACG has our own in-house construction platform, so we are not simply handing the project to an outside general contractor and hoping for the best. We have a direct visibility and transparency into pricing, scheduling, procurement, and execution. On Gresham specifically, the site is fully entitled and construction is already underway, which reduces early stage risk. We already have our guaranteed max price contract with the contractor. I think it's also important to know that, most general contractors, before they sign their GMP, they already have a list of change orders that they're going to hit the developer or owner with once construction starts. Well, since we're the GC, we're developing that list and actually working with our design team in the pre-dev stage to make sure that our change orders are limited. And so like having our in-house GC, we're not making change orders a profit center like other third-party general contractors do. There will be change orders in unforeseen circumstances, but we do a really good job of taking care of most of those up front in the design stages, which is why we typically come in under budget and on schedule or ahead of schedule.
And I think for myself, I had initially worked with several different developers, and now I've really gone a lot deeper with ACG because I just saw the delivery. During COVID, a lot of people had excuses, things were over budget, and ACG just delivered. And I think it's a combination of alignment. It's really significant principal equity involvement. It's vertical. It's a 40-year track record. But we also do the same thing as we think about these 5 to 7 story, 300 unit apartments. That is all ACG effectively does. We're not doing, data centers. We're not trying to do, high rises. We're not doing commercial. We're not doing industrial. So, we really have a product that we understand really well, that we can underwrite really well. We stick to it. And I think that's really what takes a lot of the execution risk out of it. And, BJ and I were touring, Enzo, and then, under construction site, you have hundreds of people on site. It's really remarkable the moving pieces here. And I think that's where, having just a complete focus on execution and within one asset class is so key. And that's also why I think Kinect being so close to it relative to other asset managers, right? Where they raise your money for real estate and then they might invest in 10 different developers, but they're not there with the shovel and development. I think there's a lot of risk mitigation within this partnership. So I know that we are over time, and I know many of you did not have your questions answered. And as I look at that Q&A, there's a lot of very good ones. Please do follow up with us individually. There's a lot of great questions, and we would love to help. So reach out to Ali, Anna, or Caleb, or go to either of our websites. I appreciate your time. As you can tell, we are really passionate about this and would love to share that passion with you. Thank you so much for the webinar, and we'll be in touch.